Hello, everyone. Today on the Final Bar, I'm joined by Matthew Tuttle. Matt's the founder of Tuttle Capital Management based in Connecticut. We're going to talk about the overall market environment, this push and pull between growth and value. Today, the market netting out to yet another new all-time high, new closing high. Another day, another new closing high for the S&P. We're going to talk about the overall conditions, but particularly the interest rate environment. Also, an update on all the sentiment readings. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and hot Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the activity of the markets using the power of StockCharts, using data visualization to quantify investor behavior, to visualize investor sentiment, and to empower you to make better decisions by gathering evidence and focusing on the trends. As we've talked about many times, right? The most important thing that the market can do to remain bullish is to keep going higher, right? And so in a situation where the S&P continues to make new all-time closing highs, it is difficult to be anything but bullish in that scenario. As we've mentioned before, and as I'll share with you in a little bit during the show today, I'm not struggling to find stocks that are breaking out. I'm also not struggling to find stocks that are breaking down, although I would say the breakouts certainly outnumber the breakdowns by about a 2-to-1 ratio by my general estimation, looking at a regular pattern of large and mid-cap stocks making new 3-month highs and 3-month lows. I've got about a 2-to-1 ratio of new highs. That means there are plenty of stocks that are testing support and failing and breaking down through moving averages. And more than ever, I would say technical analysis can help keep you in the things that are working and get you away from things that are not working. I would argue that's the most important thing you can do as an investor. We have great guests on the show. I'm excited to talk with Matt Tuttle here in a little bit about his perspective. Coming up next week on Tuesday, the 17th, we have Sean McLaughlin from All-Star Charts. On Wednesday, the 18th, Jay Soloff from Investors Alley. On Thursday, the 19th, Larry Berman from ETF Capital Management. They're coming up Tuesday, August 24th. Kathy Donnelly, author of The Lifestyle Trade. Also, just to let you know, I'll be doing a webcast coming up this next Tuesday, the 17th at 1 o'clock Eastern, 10 o'clock Pacific on relative strength analysis. One of the most important tools in my toolkit is relative strength, focusing on how a stock or ETF is performing relative to its peers, relative to your benchmarks. And I think it's a key way of understanding what's working and what's not, and to identify opportunities and manage risk. For more info on that event, go to marketmisbehavior.com/relative strength, where you can find out about that free event. Let's continue on with today's market recap. So the S&P continuing to push to the upside, plenty of movement underneath the hood there. So you have large caps in the form of the S&P up about 3% today. The S&P closing around 4460. Moving down, though, you have the small cap index down about 0.5%. That's the S&P 600. The cyclical leadership, for the most part, that has been the leadership in recent days and recent weeks, sort of coming back a bit today with industrials, materials, energy at the bottom of the list, although really not down a bit. I mean, just down a bit, not down too much. Well, work today, healthcare, technology really at the top of the list, and then everything else sort of in the middle. The VIX back below 16 for the first time in quite a while, and we talk about sentiment a little later in today's show. We'll focus on the chart of the VIX, and now it's really at some of the lower levels that it's been for quite some time, actually going back to 2019, to be honest with you. Other asset classes very quickly. Interest rates continuing their push higher with 10-year yields around 137, and the TLT that we often use as a proxy for bond prices down about 0.2% today. The dollar index continuing to fluctuate right around 25 on the UUP. Looking at commodities, gold ended the day just a little bit in the positive, but it was pretty much a zero day. And then it opened down, and so spent much of the day clawing back to that zero level. Commodities as a whole down, as I mentioned, energy prices a little lower, the energy sector a little lower as well. Cryptocurrencies, I don't know if coming back to earth is the way I would describe it, but certainly rotating lower. As we've talked about the chart of Bitcoin, the daily chart of Bitcoin tells you a good amount about the long-term trajectory, but it's such a volatile asset class. If we call cryptocurrencies their own asset class, which I think we can, certainly plenty of volatility. I would argue certainly some time compression. So things that in other assets and other eras may have taken longer. I think those time frames are most likely compressed. So you can see some of these wave-like patterns in the shorter term data. It's just a two-day chart of Bitcoin, and you can see how it's rotated from an uptrend to a downtrend just in that short-term period of time. So an hourly chart can be really helpful. Even if you're not an intraday trader, a day trader, you're not trying to play swings, but just to understand the trajectory, especially making sense of the weekends and how things get back going during the week, might be helpful to pay attention to hourly charts on something like Bitcoin. Continuing on, let's focus on a chart of the S&P 500. As I mentioned, another new all-time high, a new closing high for the S&P, closing above 4460 for the first time. And again, this is a bit of a broken record analyzing this chart. I would say three things about this chart. Number one, the price is above two upward sloping moving averages. That is, by definition, a pretty strong chart. Number two, we continue to make new highs. And as Paul Montgomery, legendary technical analyst, once said, the most bullish thing the market can do is go up. And so we are seeing that play out regardless of what the individual stocks are doing. The overall movement of those names as aggregated into the S&P 500 is going higher, and we're continuing to see new highs there. The third thing I would say is your risk management is fairly straightforward at this point using the S&P, because the 50-day moving average has been the place where the S&P has pulled back to a number of times, 6+ times so far just this year. And it's been a very good measure of this upward trend. I would say at some point, we are going to pull back. It doesn't seem to be happening today. And regardless of the fact that we're in the seasonally weakest month of the year, August, and we're in the seasonally weakest season of the year, sort of that July, August, September stretch, the market doesn't seem to care. It keeps pushing onward and ever upward. So it tells me that the market's in an uptrend. It tells me if we do pull back, that the 50-day moving average is a pretty good place to look. At some point, those two things are no longer the way you would describe the S&P. We're no longer making new highs, and then we fail at the 50-day moving average. At that point, we will start talking about some alternative scenarios and deeper pullbacks and what to do about it. Until then, though, the path of least resistance certainly seems to be higher. Quickly, just reviewing the leadership today. So you have healthcare bouncing up. Healthcare is actually one of the laggards recently, even though you've had some really nice breakouts in some of the healthcare names. You've had a number of stocks sort of breaking out, and the fact that pharmaceutical stocks have participated in the uptrend where they had not necessarily been as much before, pretty impressive, but bouncing higher today, followed by technology. The chart that comes to mind as I'm thinking of technology is Apple. We've talked about this chart. Look at a little shorter term chart. I threatened that this was the one chart you needed to pay attention to. And we're going to look at it right now. I think the story of the market has been the story of this chart of Apple, because the consolidation phase last September and October is on the left side of this chart here. You can see the symmetrical triangle pattern, lower highs, higher lows, as Apple was sort of consolidating. And then you can see that resolved to the upside. And I think here in December, when you broke out of that pattern to the upside, that pattern did not resolve down, it resolved up. That indicated some strength overall in equities. That was one of the names that started to appreciate and accelerate into the end of last year. Then all of a sudden, you once again had Apple lagging behind as other things. The cyclicals really started to make new highs March, April, May. This is when all the banks were, going up and to the right. And then you had Apple and a lot of the FANG stocks sort of consolidating yet again. You had lower highs and higher lows as Apple sort of entered another coil pattern or symmetrical triangle pattern. This moment right here was, I remember this day, and I remember talking about Apple breaking down through the symmetrical triangle pattern, breaking down through the 200-day moving average. That's pretty much it, right? All you need is follow through, an indication that the 200-day has failed, a continued move in that direction to indicate that that is not the end, that there's much further downside. And I think the market looks very broken very quickly. That immediately did not happen. It immediately turned up. We had one day of closing below the 200-day and pop back up to the upside. We quickly entered that pattern yet again and resolved it to the upside, where you did have follow through, which indicated really a resumption of the leadership of the growth stocks. And that's what we saw in June and July. For a third time now in the last year, you have Apple in a consolidation pattern. It's a little shorter term, is what I might call a pennant pattern of an acceleration to the upside, followed by lower highs and higher lows as we narrow this range and settle around an equilibrium value of around 146. With today's move higher, closing just below 149, we are arguably at the point where Apple is resolving this pattern to the upside. And what I've said recently is whichever way Apple ends up resolving, whether we get above 150 and a follow through to the upside or below 142 and accelerate or break this pattern to the downside, I think whichever way that chart breaks, I would not be surprised if the overall market follows in that direction, or at the very least provides a sense of a market tailwind if we break out, or a market headwind if we break down. Today, we are right at the upper end of that boundary. I think tomorrow we could follow through to the upside. And if so, I think that signals a really strong potential, at the very least, for some of these FANG stocks that had been destabilized a little bit, resuming a bit of an uptrend. So it's a key chart to watch, and the fact that we're sort of right at that decision point today is an important one to pay attention to. Finally, just to finish off, when I'm looking at the groups making highs or lows, I just wanted to point out a number of healthcare groups represented in the top 10 industry groups today: medical supplies, medical equipment, two groups we've talked about quite a while, as well as biotechnology. So if you have not been paying attention to the healthcare sector, I hope you have, because we've been talking about a number of those names that have been in pretty good trends, but this is a group that bouncing very nicely. And it's all about whether we're able to eclipse the previous highs and remain in those strong trends. We need to take a quick commercial break. We'll be back with my guest, Matthew Tuttle. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. A couple quick announcements, then we'll get to today's guest, Matthew Tuttle. First off, questions are always welcome. Questions about the markets, market history, market dynamics, technical indicators, particular charts that you're struggling with. Let us help you point you in the right direction. 3 ways to get your questions to us. Number 1, via email, thefinalbar@stockcharts.com. Number 2, via Twitter @FinalBarSCTV. The third way is on our YouTube channel called Stock Charts. Just put a comment below the video that you're watching. We would love to hear from you, love to hear your questions. We'll do another mailbag segment on tomorrow's show on Friday. Love to answer your question on the air. Also, go to StockChartsTV.com. Use your email address. You can set up a free account, start watching all of our great content immediately from our website, also from all your mobile devices. Great guests like Matthew Tuttle, special events like the final, that's my show, like The Pitch, and charting the second half are featured on there, and great shows like The Final Bar and many, many others. Go to StockChartsTV.com, or on your mobile device, just search on the App Store for StockCharts TV on demand. I want to welcome on today's guest, Matthew Tuttle. Matt's the founder and CEO at Tuttle Capital Management, coming to us from Connecticut. Matt, welcome back to the show.
Hey, thanks for having me.
Absolutely. Now, obviously there's been a lot of themes to follow in the market, a lot of places we could go, but we talked a little bit before the show started about the interest rate environment. And I know this is the movements that we've seen in interest rates are certainly catching people off guard a bit and trying to understand what this means, setting up for the markets going forward. Talk us through this chart. What are you seeing?
So what we're seeing is really the Treasury tail wagging the dog. So at the beginning of the year, you saw Treasuries getting crushed. You saw that kind of in the impact on growth versus value. So value was really doing extremely well versus growth. You kind of had the whole world jumping on the reopening trade and everyone selling the stay at home. Then Treasuries bottomed, they started to rally, that switched around. Everyone was all in on growth and out on value. And now you're starting to see that reverse again. And you've seen rates start to climb, especially with some of the reports we've had both on jobs and inflation. And the idea that now Jackson Hole is going to be a live meeting, and really good chance that we hear some interesting things out of that. And you're starting to see now this reversal. But it's interesting where, the moves in treasuries have become so correlated with what's going on in growth and value.
So we've seen, as you mentioned, right? I mean, it felt like the value trade just worked incredibly well, sort of in that April, May period, maybe early June, and then things start to revert a little bit back. Now you get sort of financials breaking out to new highs where they had not been before, the infrastructure trade kind of returning. When you look forward and think about August into September, October, November, sort of going further on, where would you be leaning into? Is it betting on these value names to continue to do well, assuming rates continue to go up from here, or do you see something differently?
So, in the current scenario, we got to assume rates are going to go up, and that's going to have a positive effect on value stock. I mean, obviously, the wild card here is COVID. If we start getting rises in Delta cases and lockdowns again, then forget everything I just said, because the whole world piles into treasuries and value stocks get crushed. But, in the current environment, you can't help but believe rates are going to go higher from here. You can't look at that jobs number and say that's not substantial further progress. So, yeah, I mean, to me, that favors don't buy bonds, buy value stocks.
You mentioned, you obviously brought up COVID-19, which I know we're all sort of struggling with the uncertainty of that. When you think about it from a money management perspective, how do you manage that risk or that unknown of something like this, right? Sort of an X factor that has the potential to certainly disrupt a lot of things. Is that something that you manage in terms of your positioning, or is it just an acceptable risk to taking on, to go into any sort of risk asset at this point?
So I don't think it's an acceptable risk, and we do manage it. So one of our ETFs, FAT-T, is designed to be a positive carry tail risk ETF. So it's designed to be able to do okay when the market's going up, but really to shine if we get, like a February, March of last year COVID type of event. So, in my own portfolio, I keep a big chunk of that just in case. Because, yeah, I mean, I remember very vividly February and March. That's something I don't think you just say, all right, I just hope that doesn't happen.
Hope is never a great investment strategy. Someone
hope
once
is
told
not
me
a great,
like
yeah,
that.
exactly.
Now, when you're thinking about just the overall market environment, we've obviously seen the S&P continue to push to new highs. We've gone through, I feel like, a number of opportunities where there could be some distribution, and you really don't. You get brief pullbacks, and then this uptrend continues. Is there something that you would see or hear, and what would that be that would convince you that this, relentless uptrend that we've been in is starting to change? What would be the warning sign or an indication that things are no longer in that bullish structure that we've continued to see through today?
So a couple of things. I mean, it's interesting. You always see articles, hey, the market hasn't had a 5% drop since like October. But what that ignores is if you look at the sectors, the styles, the themes, the memes, all of that stuff, that stuff is moving. And, name your sector, name your style, name your theme. All of those have had 5% or more drops since October. So that's where the action is, but you don't see it in the broad market because money is moving from, energy to tech, from tech to financials, and the S&P isn't showing it. So I'd start to get worried when money is going out of, name your sector and theme, and it's going into cash. And then you're starting to see it in the broad market. Also interested to see what happens once the Fed announces what they're going to do and, how they announce it, how they play it, and what the market's reaction is. My sense is the market's not going to react well to that. So, that's something we're going to be looking at as well.
A lot of uncertainty, but Matthew Tuttle, thank you so much for walking us through how you're approaching this, how you're managing some of the risks that are inherent in the equity environment right now. Matt Tuttle from Tuttle Capital Management. Thanks for joining us. Be safe, be well. We'll talk to you again soon.
All right, thanks.
This is Matt Tuttle. Matt is the founder of Tuttle Capital Management. He's the creator and the manager of ETFs. You may have heard of things like FOMO, SPCX, and actively managed SPAC ETF, and many others, a fat tail risk one that he mentioned as well. Really appreciate him sharing his thoughts and how he is approaching this current environment. You know, as I was talking with Matt and getting his take on the S&P, I'm looking at the chart of the S&P as I'm asking my question, and just struck yet again. I look at this chart many times every day, but just the persistent uptrend, just this consistent upward move. And I've had plenty of moments along that uptrend where I've talked about conditions that could be forming, divergences, breadth, sentiment, all these things. But regardless, I mean, despite all of those potential negative tells, the markets continue to push higher. And it's all about that rotation I think Matt was just alluding to. Our next segment here, Getting Sentimental, is where we're able to focus a little bit on particularly the sentiment readings. We might touch on a little bit of breadth as well, but I wanted to start with the volatility picture of the VIX. And the reason is because the VIX is really at nearing the lowest level that it's been really right before the February 2020 market peak. So starting there, the VIX and more broadly speaking, sentiment, just as we often review when we do this segment, you know, I think of the macro strategy, or my general macro strategy, is starting with price and then breadth and then sentiment. And that's the priority order. The most important thing we can do is focus on price, which is why probably 80% of this show, if not more, is focused on price and focused on how trends are evolving and when stocks are rotating higher or lower, when assets, ETFs are rotating higher or lower. The second piece of that, where we probably spend another 15 to 20%, is on breadth and thinking about the breadth environment, right? The participation. We often talk about advanced decline lines and stocks above or below moving averages, bullish percent indexes as a way of validating what we're seeing with price. And then the third piece of that, which is probably 5% or so, and I've lost track of how many percents I've allocated, but we'll give it 3 to 5%, would be sentiment, which is looking at surveys and looking at volatility data and positioning data as a way of understanding it. And that doesn't mean it's not important, because it is. And I would say some of the better senses I've had when I felt a good sense of where the market is headed, a lot of times it starts with sentiment. It's picking up on signs of euphoria that then you're able to validate by analyzing price and breadth. And that's why I think it's an important piece of the puzzle. If you don't know what I'm talking about with sentiment and contrary opinion, best book I've read on it is by Humphrey Neal, and I think it's The Art of Contrary Opinion, or something that has contrary opinion in the title. Does a great job of describing sort of the contrary opinion methodology, how to think about where the masses are and how to think opposite to that. Now, starting with the VIX, again, I think the VIX, as with many market indicators, are imperfect by design. There's no holy grail indicator that's going to give you a perfect read on the environment. The VIX has its challenges. We talk about the VIX being the fear gauge. We talk about, market bottoms or market downtrends marked by elevated volatility because it's uncertainty, right? People panic and the market becomes more volatile. And so there's an inverse relationship. And if you take a step back and if you flip the chart of the VIX over, you'll see that it matches fairly well with the S&P. However, there are times like, August of 2020 and others you may find on the chart where the market actually goes higher and the volatility increases. So it is not a perfect inverse relationship because it's not measuring the inverse of the S&P. It's measuring volatility, and it's not a one-to-one relationship. However, I think it's important to think about this overall volatility regime, and you can see the spike in volatility we had February into March of 2020, all-time highs for the VIX, or very close to that. We then settled into a range between 20 and 40 here through the second half of 2020 into 2021. We then have had sort of the lower volatility range that we've had recently. However, we're still well above where we were in previous cycles, right? In 2019, sort of in the 6-month period leading up to the February 2020 high, we actually had a very low volatility environment. Between 10 and 20 was sort of the accepted range of the VIX back then. Now we are nearing the point where we're at the lowest level we've been since that point. The VIX at the beginning of July was around 15. We rotated back higher, and now we're right back near those levels. And while that on its own does not indicate a market top, and I can't tell you that the VIX 15 would be a sell signal by any stretch of the imagination, I can't help but notice that based on previous recent history of the last 6 months, when the VIX gets down to this lower end of the range where it's been, it's more often than not been the end of that move. It's been an exhaustion signal where the market pulls back a little bit. So we are nearing that point, similar to where we've been in short-term market tops, certainly over the last 6 months or so. Other sentiment readings, just to highlight very quickly, the AAII survey, really no real change in this one. You still have about 37% bulls. You have about 32% bears. That's not far off from where we were last week. And so what that means to me, overall, it's in bullish, but not euphoric. So it's an acceptable bullish range. This is where investors are usually the normal level of bullishness on average for an extended uptrend. The euphoric readings are when we get above 50%. The last time we were up in that sort of range was here in April, which is where I would argue that rotational environment that Matt Tuttle was talking about earlier, my guest today, that's where I think that started. I think that's where this stealth correction that we are still in sort of began, where it's all about leadership rotation. It's less about markets reversing and the S&P selling off with any sort of significant momentum. So overall, still fairly supportive of the market going higher from here. The name exposure index remaining around 98%, which is not above the 100% level. I was very curious this week if we would get above 100%, which is my general line in the sand for, or a back of the envelope measure for euphoric measurements, meaning money managers are net leveraged long. We're not quite there. We're sort of still within the acceptable bullish, but not over bullish sort of range. So what's interesting is from the sentiment readings, we're still actually in a healthy, things are not ending anytime soon sort of moment. Now, again, the most important things I would use to make that determination are price and then breadth, but it's worth noting that we're not getting any sort of warning sign, I would argue, from sentiment at this time. It's still fairly constructive with where we've been so far. That is our segment, Getting Sentimental. We have to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is Chewy from the consumer discretionary sector. There's 3 stocks I'm going to share with you today. Part of my normal routine with my own market misbehavior premium clients is going through and identifying stocks, making new swing highs and new swing lows, sort of picking out a bottom-up analysis of themes. I'll touch on you 3 that I shared with them earlier today that are sort of ideas of stocks in a rotational mode. Chewy is one that strikes me. There's a whole basket of stocks that we talked about that are rotating from a distribution phase to an accumulation phase. Arguably, a lot of banks look kind of like this chart. Timing is a little different, but had a nice run, rotated down and now started to rotate back and making new swing highs or new all-time highs. Chewy is one that's actually this nice orderly rotation from distribution phase in the first half of the year to more of an accumulation phase. The relative strength from a downtrend to an uptrend, not yet overbought, and I think that's setting up very nicely for a strong uptrend. Second category of names that we talked about, something like Ulta Beauty comes to mind as a great example of that. These are stocks that are breaking out of bases. Now we have to be careful with this because this is what Amazon looked like just before it failed. It was a failed breakout. It came back within that range, but with something like Ulta, you have resistance around 350. We established that in March. We tested it again in May, and in June, we've now rotated back and made new highs there for the 52 weeks. I like the fact that the relative strength is starting to improve as the stock is indicating an influx of new buyers or an increase in buying power. Either way, it's going higher. Not everything else is going up, and there are plenty of stocks, as I mentioned. I'm not struggling to find stocks that are breaking down. Constellation Brands, ticker STZ in the consumer staples sector, is probably a good example of that. If you take the Chewy chart and flip it over for the last year, it kind of looks like this. This is a stock that is, instead of rotating from downtrend to uptrend, this is rotating from uptrend to downtrend. Charles Dow would love this example of higher highs and higher lows reversing to lower lows and lower highs. It's now below its 50-day moving average, below the 200-day moving average. And I would argue breaking that 200-day is sort of that final indication that this is something you lean away from until proven otherwise. The trend is down until it stops going down. The relative strength deteriorating is certainly a big piece of that puzzle. Those are 3 names that came up in my own scans in the last 24 hours. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Matt Tuttle joining us from Tuttle Capital Management in Connecticut, sharing his thoughts about the big picture environment. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.